we detected unusual trades worth about $2.6 million on American Airlines stock, ticker symbol AAL. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish and buying or bearish and selling American Airlines. Because as we all know, the rich have more access to information, including leaked insider information, to make better financial decisions. No wonder the rich get richer. And so to level the playing field, let's dive into the data analysis of this wealthy investor's trade. As we can see here on the options time and sales tape at 2:43 p.m., these March 21st options at the 16 strike puts and the 17 strike puts were being traded for a price of $66 each and $117 to $118 each. And because these 15,000 contracts and 10,000 contracts are for the same 17 strike puts, we can add them up for a total of 25,000 contracts. Now, based on our analysis, this wealthy investor was closing out of these 25,000 contracts at the 17 strike puts to take profits and rolling these options to a lower strike price, the 16 strike puts. This means that these 40,000 contracts are the new opening trades. And so we can calculate the cost of this trade, the quantity of contracts, 40,000 multiplied by the price of $66 each, and we get a total of $2.6 million. But keep in mind, this is a higher risk trade in comparison to the trades that we share with our members. And so if you want to get access to the lower risk and higher probability of profit trades, then go to our website. We'll put a link to our website at the top here where you can get access to better trade ideas that the wealthy investors and potential insiders are trading, because not all of these unusual trades will be profitable. Some of them will be a loss, but as long as we diversify our portfolio with higher quality stock picks based on stronger data analysis, then we can become more profitable in the long term. Now, with that said, you may be wondering why this is a higher risk trade in comparison to the trades that we share with our members, and how did we know these 40,000 contracts were new opening trades while the 25,000 contracts were closing trades? Well, to answer these questions, let's dive deeper into the data on the option chain to analyze this trade further. As we can see here for the March 21st options at the 17 strike puts. Notice that these options had an open interest of 32,000 contracts, which is more than the 25,000 contracts being traded by this wealthy investor. Whereas at the 16 strike puts, the open interest is 19,000, which is less than the 40,000 contracts being traded. As a result, it would not be possible to close out of 40,000 contracts if only 19,000 contracts were open. And so based on our analysis, this wealthy investor was closing out of these 17 strike puts, which, by the way, are now in the money because the stock is trading below $17 per share. By closing these options, this investor is locking in profits because the closing trade is worth more in price in comparison to the new opening trade. And so this wealthy investor is rolling these options to a lower strike price by opening a new position at the 16 strike puts. This data is very important to analyze because we need to fully understand what these wealthy investors are doing so we do not make the mistake of following the wrong closing trades. So always make sure of this, because this is one of the common problems we see other websites and scanners make when they report unusual option activity. They do not examine the data carefully to filter out closing trades and simply report every unusual options trade with high volume, leading to inaccurate results and losses. Now, with that said, because the 16 strike put options were the new opening trade, we also opened this same position here. POS stands for position, and the green color means buy, because we also bought these put options for these $66 each, the same price as when those unusual options were being traded. And so when we analyze this trade, You can see here on the risk profile profit loss graph where the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple and blue lines are trading above it, this trade becomes more positive, profitable. And if it trades below it, this trade becomes more negative, loss, because this is a short bearish trade. And we can confirm it here on the Greeks. We have a negative delta trade. If it was a long bullish trade, it would be a positive delta. But be aware of the risk of this trade. We have a negative theta decay. And so as time goes on, this trade will lose in value. And that is why you can see the purple line, which represents the current date, drops down lower to the blue line, which represents the option's expiration date. Since these options lose value through time, the break even on this trade moves lower as we approach the expiration date. And so you can see here, even though these put options have a strike price of $16, the stock needs to trade below $15.34 per share for this trade to be profitable at expiration. And because of this higher risk, along with the possibility that this wealthy investor could be trading these put options as a hedge against underlying stock shares going long bullish, we manage our risk by using position sizing. We don't use a lot of capital for these higher risk trades because we use most of our capital for the lower risk, higher probability of profit trades that we share on our website. We'll put a link here where you can also learn more trading strategies to reduce risks while increasing profits. Let us know in the comments below. Do you think American Airlines stock will crash down, or do you think it will go up? As usual, please hit the like button, subscribe if you haven't, take care, and have a wonderful day.